Thank you for coming. My name is Colby McFadden. I am the Managing Director of Quiver Asset Management. Let me just spend a few minutes explaining who we are and what we do for people, and then I'll get into the actual presentation of Einstein's 5 rules to bear market investing. We manage money. We manage just under about $50 million between 130 and 140 clients. And we're happy to say that that dollar amount, that management dollar amount, has stayed stable over the past year and a half as the markets have deteriorated. So we're very happy to see that be the case. One of the reasons that our level of management has stayed stable over these past 2 years is because of some of the things that I'm going to talk about. Back in '01, it became apparent to us as a firm that we were entering into a long-term bear market. Not something that was going to last just for a year and a half, but something that could last for a decade or more. And I'll get into a little bit about that in this conversation and explain why we feel that the situation we're experiencing in the economy and in the markets is something that is of a natural occurrence. It's something that we've seen before, and the way that we'll work our way out of it is the same way we've worked out of it before. A lot of hard work, ingenuity, and creativity is what's going to work for us. Like I said, back in 2001, when we started to see the first decline in the markets, I started to do a lot of homework on markets, on economic cycles, on inventory cycles, get a really good feel of what was happening in the markets, so that way I could properly advise my clients. There's nothing worse than getting a call from a client, because all of our clients are retired. They're all over the age of 65. We're managing the assets that they need for retirement, and a good majority of them need these assets for income. And there's nothing worse than needing to create a 6 or 7% level of income and then seeing your assets decline 20, 30%, because that puts a really big crimp on what your future plans are. And if you worked your whole life to save money, the last thing that you want to do during retirement is start to focus on cutting back expenses or pinching corners here and there, because you already did that in your 20s, 30s, 40s as you were raising kids and creating a household. So at this point in life with retirement, you want it as comfortable as possible. And so the advisement that you get is very important in these times. So back in '01, I started looking at the markets and saying, how can I create a system for my clients, for our firm, that gives them the ability to make money in either market, bull market, bear market, positive markets, negative markets. And the reason we picked the name Quiver Asset Management was twofold. One, I'm a surfer. I've been a waterman all my life, and in the world of surfing, you have a quiver of surfboards. If you go to my garage, you'll see 25 different surfboards. I have a house down in El Salvador that has another 10 surfboards. People say to me, why do you have so many surfboards? Well, because every day the conditions of the ocean are different. So a different board for different conditions. In archery, archers have a different quiver of arrows for different shots. So we looked at that, and we looked at what has gone on in the financial markets over the past 10 years and the development of so many different investment products. You've got individual stocks, you've got preferred stocks, you've got bonds, you've got exchange-traded funds, you've got open-ended mutual funds, variable annuities. Nowadays, there's so many investment products out there that there really isn't any reason, regardless of what the market condition is, that we can't find a strategy within our quiver that will either preserve capital or find ways to increase capital. So throughout the first bear market that we saw in '01 and '02, we went on just a search of how can we broaden our quiver of knowledge to be able to bring it to our clients. And in that search, we started to realize that we were going into a cycle, an economic cycle, that we haven't seen since the 1930s. And I know a lot of people don't necessarily want to compare what we're having right now to a Great Depression or things of that nature. But when you study economic cycles, you really get to see how these cycles play out over time. And that'll lead me to the first rule, Einstein's first rule to investing. And then this whole compilation of what we put together is actually 5 quotes. Because Einstein didn't really have any rules to invest in. In fact, he was a very bad investor. He lost most of his money on a series of books that he tried to publish. But he had some incredible quotes. I mean, you look through Einstein quotes, they're just some very logical, sensible quotes. So what we thought we would do is take some logic, some sensibility, and apply it to these markets.